I think there'll be demolition. I don't think it's controlled in any way. Look, I mean, revaluing gold, our official value, I mean, doesn't change anything. I mean, if you just say, okay, we're going to count our gold, instead of saying it's worth $42 an ounce, we're going to say it's worth $3,300 an ounce. That's just an accounting. It means nothing because, we're not doing anything with the gold. And if the U.S. government was going to sell the gold, it wouldn't sell it at $42. It would sell it for the market price. So it doesn't change anything. There are people who think, well, this gives us extra money to spend. No, it doesn't. It doesn't give us anything. Senator Loomis says, well, let's revalue the gold and then use the money to buy Bitcoin. What money? There is no money. There's just the gold. You don't get any extra money. But if what she's saying is, well, let's use the gold and somehow print more money. Let's have the Fed print up a bunch of money because we've now officially recognized what the gold is worth. And then we're going to take that new money that we just printed and use it to buy Bitcoin. It's like, okay, let's create inflation and buy Bitcoin, right? Why would we do that, right? Why would we just debase the currency just to go out and buy Bitcoin? So it doesn't solve any problem. The only thing that would make sense about a revaluation of gold is if we're going to maybe back on a gold standard, have an official devaluation of the dollar, including of our debt. Because if we were to say, okay, gold is now $20,000 an ounce, and we're going to repay our debts in gold at $20,000 an ounce, right? So now, we've basically defaulted on a lot of our debt without really defaulting because we're going to pay it off in gold. And we just said that the gold is now worth 20,000 or 30,000 an ounce. So we wipe out 90% of our debt. But it doesn't even make sense to do that unless you're going to peg the dollar to gold and maintain that. But, at this point, and initially, of course, the dollar wasn't pegged to gold. The dollar was gold. I mean, that was the literal definition of a dollar. A dollar was a weight of gold. That's what it was. It was a way to measure gold. If you had a certain quantity of gold, it was called a dollar. That was the legal definitions. Gold was our money. Our money wasn't backed by gold. Our money was gold. What we eventually did is we created currency that was backed by money. But the currency was never money. It was a money substitute that you could use instead of money because it was more convenient than money. But what gave currency value was the money that backed it up, which was gold. So if we were to go back on that standard, yeah, that'd be great. And we can't do it unless we devalue the dollar officially and reprice gold. But I don't see any appetite in Congress to do that because that would mean they'd have to cut spending. And so, but they're not cutting spending now. So why do they want to go back on a gold standard that would force them to cut spending? The reason we went off the gold standard is because politicians wanted to spend a lot of money that they didn't have. Gold was preventing them from doing that. And, when I hear people in the crypto community say, oh, gold didn't work, gold failed. Gold worked perfectly. That's why the U.S. government abandoned it, because it was doing its job. It would have stopped them from deficit spending. It would have forced politicians to make difficult political choices that they didn't want to make. So instead of making those choices, they chose to leave the gold standard, right? But that doesn't mean that gold failed. That's people, human beings failed, right? And Bitcoin doesn't fix that. Donald Trump has made it clear that we can't have these trade deficits. And okay, that means we're leaving the dollar's reserve status because it's a consequence. Our trade deficits are a consequence of the dollar being the reserve currency. And that's what enables us to live beyond our means. And this is in the process of ending. And that's why gold moved from about $2,000 an ounce at the beginning of last year and to now, 3,300, right? It's got as high almost 3,500. So if we've had a 50% move in the price of gold. During that time, you didn't see a lot of public interest. I mean, most Americans were selling gold for that entire run. It's been central banks that have been accumulating. And why are they accumulating gold? Because they are divesting of dollars, right? They are converting their dollars into gold, and they're shunning the interest that they could earn, because when you have dollars, you could buy treasuries and earn 4%. When you have gold, you earn nothing. In fact, you got to pay a little bit of money to store it, or maybe you've got your own storage facility, but you got to pay for the facility. It doesn't cost anything to store treasuries, and you get paid a yield. But the fact that these foreign central banks don't want that yield shows you that they realize the yield is not enough to make up for the loss of value of the dollar. And so they'd rather own gold that yields nothing than dollars that yield something. And so far, the return that they've had on their gold dwarfs the little bit of interest they would have earned on their dollar. I think for that reason, gold's going to keep on rising. If you look at the amount of gold that most central banks own, particularly in the emerging markets and the countries that have the largest surpluses with the US, they have the most foreign exchange reserves. They still have a tiny fraction of those reserves allocated to gold. And they keep growing because they keep accumulating more dollars because they keep having these surpluses with us. So more and more of that money, of those currencies, are going to move into gold. So gold is replacing the dollar as the primary monetary reserve. It's not the euro that's replacing the dollar or the pound or the yen or the RMB or any of these currencies. It's real money. I mean, because before the dollar was the primary reserve, it was gold. And the only reason that the dollar was accepted as the reserve was because it was redeemable in gold. So if you had Federal Reserve notes in the 1950s and 1960s, you had gold. When they said the dollar was as good as gold, they meant it, because the dollar was gold, except you could earn interest. Now, we screwed the world over when we defaulted on that promise, but it was initially gold that was the reason the world accepted the deal at Bretton Woods. So I think that is in the process of changing. But what's interesting from your perspective, and you should think about this, is if you're so sure that Bitcoin is the new gold, is superior to gold, is better than gold, why are these central banks not buying it now? Why are they all buying gold? If gold is the past and Bitcoin is the future, why are all these central banks ignoring Bitcoin and just buying gold?
Because full of PhDs that don't understand economics, obviously.
Yeah, I think the foreign central bankers,
they'll come around
know a lot more about economics than the millennials in the United States. I looked at a statistic. I think 40% of all the Bitcoin is owned by Americans. And about half of all the people in the world who own Bitcoin are Americans. So this is becoming an increasingly U.S. thing, as Americans are some of the only people dumb enough to buy it. Like we're loading up on all this crap as the rest of the world is getting rid of theirs. They're selling us their Bitcoin, and they're buying real things. They're making real investments. They're building factories. They're making consumer goods that improve people's lives. What do? We manufacture meme coins. What the hell does that do? And then we trade them.
There's something really strange about the moment we're living through. This bizarre calm before the storm. Everyone's acting like the system is fine, like the numbers on the screen are reality. But I'm here to tell you, the economic Titanic has already hit the iceberg. We're just waiting for the band to stop playing. You can dress it up with rate cuts. You can drape it in stimulus. You can even paint little rainbows on unemployment numbers. But at the end of the day, we're broke, and no one wants to admit it. Now, I know that sounds dramatic, but let's look at the bond market. You've got people saying the Fed is going to cut rates again. But what happens when they do that? Long-term rates rise again. That's exactly what happened the last time they cut. The 10-year jumped. The 30-year jumped. They were trying to push rates down, and the market pushed right back. That's a failed policy, not a soft landing. That's your bond market screaming, "Nope, I'm not buying it." And here's the part nobody's willing to say out loud. Interest rates are still historically low. Yes, you heard me right. 4-5% may seem high if you were born after 1990. But go back to any time before the Fed started juicing the system like a frat boy on Red Bull, and you'll see that 5% was normal. But here's the problem. We can't afford normal anymore. Not with $34 trillion in national debt and counting. If rates were allowed to normalize, the US government would default, either explicitly or implicitly through inflation. You don't lend money at low rates to people drowning in debt. That's basic lending 101. You charge higher interest when the borrower is high risk, and if the borrower is the United States government, with deficits blowing past $2 trillion a year, entitlement programs on autopilot, and no political will to rein it in? Well, folks, that's the definition of high risk. But what are we doing? Pretending we're solvent. Pretending we're still that post-war industrial giant with a balanced budget and a trade surplus. We're not. We're a hollowed-out shell running on fumes and wishful thinking. And let's talk about inflation. It's not going away no matter how much they cook the CPI. The Fed can't solve inflation with interest rate policy anymore. We're too far gone. So what's next? QE, that's right. Quantitative easing is coming back, and when it does, it won't be a gentle drizzle of liquidity. It's going to be a biblical flood. Why? Because the next crisis won't be some little financial hiccup. It's going to be a confidence crisis of the currency. Look, if the bond market starts to tank, and it will, the Fed will step in. They'll buy everything: treasuries, mortgage-backed securities, corporate debt, maybe even stocks. They'll have to, because there won't be any buyers left. Foreigners are already dumping U.S. assets. They're selling our bonds, our stocks, our dollars. They're not interested in holding our paper. Why should they be? If you're in Europe and the dollar is sliding, why would you buy treasuries yielding 4% when you're losing 10% in currency translation? You wouldn't, and they aren't. And you know what that means: more Fed intervention, more balance sheet expansion, more inflation. And what's that going to do to the value of the dollar? Hint, it's not going to make it stronger. The more the Fed prints, the less people want to hold those dollars. And that triggers the worst kind of doom loop, because the Fed's attempt to stabilize the bond market actually destabilizes the currency. And as soon as the rest of the world figures this out, and some of them already have, the dollar is toast. Now here's where it gets really ugly. The U.S. economy is built on two things: cheap money and cheap imports. If we lose access to either one, it's game over. And we're losing both. Tariffs, deglobalization, supply chain disruptions, they're driving up prices. Meanwhile, we can't print our way out of that without killing the currency. That's how you slide into stagflation, or worse, hyperinflation. And once you go down that road, there's no easy way back. Let me ask you something. If you're a foreign central bank and you see this unfolding, what do? You sell dollars, you sell treasuries, and you buy gold. That's exactly what they're doing. In fact, they've been doing it quietly for years. Look at the numbers. Central banks are accumulating gold at the fastest pace in modern history. Why? Because they don't trust the dollar anymore. They don't trust the Fed. They're not saying it out loud, but their actions are screaming it. And what are Americans doing? Selling their gold. That's right. While the price is rising, people are pawning off their last real assets so they can afford rent and groceries. Meanwhile, central banks are hoarding gold like it's going out of style. Let me tell you something. That's the smart money. And when the smart money is buying gold, you might want to pay attention. Now, I know there's this weird narrative floating around that revaluing gold is going to solve everything. Like all we have to do is officially recognize that gold is worth $3,300 an ounce instead of $42, and suddenly we're rich again. That's not how this works. That's not how any of this works. The U.S. government isn't going to sell its gold at $42. If it were going to sell it at all, it would sell it at market price. And even if it didn't, revaluing it on a spreadsheet doesn't magically give us new money to spend. It just changes the optics. The debt is still there. Some people say, well, what if we print money based on that new valuation and use it to buy Bitcoin? First of all, that's just replacing one form of insanity with another. You don't solve a monetary crisis by creating a new speculative bubble. That's like curing your gambling addiction by going to Vegas with a new credit card. Second, the idea that we can print money based on gold we haven't sold just because we updated its theoretical value is absurd. It's fantasy economics. It's the kind of thing you'd hear from someone who failed Econ 101 but crushed it on Reddit. The only reason to revalue gold is if you're serious about going back to a gold standard. And I don't mean some half-baked gold-backed stablecoin on a blockchain. I mean a real, honest-to-God gold standard where every dollar represents a weight of metal. That's the only way revaluation matters. Otherwise, you're just playing games. And you know what a real gold standard would mean? Fiscal discipline, balanced budgets, no more printing money to pay for everything under the sun. In other words, everything Congress doesn't want. That's why we're not going back. Not because it wouldn't work, it would, but because it would require accountability. And Washington would rather burn the dollar to the ground than be held accountable for anything.
QE is going to come when the bond market, I guess to use Trump's words, really gets yippy. But
But
maybe when
we're already higher than when he first said it was getting yippy.
yeah, I mean it's about the same. It's not it's because we had gotten to about 4.5 on the 10-year and about 5 on the 30-year, and so that's about where we are. But those are still low rates. They're not as low as they were, but if you go back, since the end of this Second World War, those are still low rates that we've got. And considering
High for
how
the
much
amount
debt
of debt we have, though.
we should have higher rates. When the more debt you have, if somebody goes to borrow money and they don't have a lot of debt, and you go to a bank or a lender and you've got a pretty good personal balance sheet and you want to borrow money, you'll get a certain rate. But if somebody else comes and they're loaded up with debt and they want to borrow money, they're going to pay a higher rate because they're a greater risk. They have a lot of debt. So that means that they may not be able to pay it back. So you don't want to loan money to somebody who's already broke. You want to loan some money to somebody who can pay you back, easily. And so we're broke right now. We have trillions and trillions of debt, yet we still have interest rates as if we were, solvent, which we're not. But I think that the position we're in now is that if the Fed cuts rates again, long rates are going to rise again, just like they did before. The Fed cut rates to about 100 basis points. But then long-term rates rose 100 basis points. So the long-term rates did the opposite of what the Fed wanted. And I think that if the Fed goes back to rate cuts, the long end is going to go up. And that's going to be because the bond market is going to be worried about the inflationary impact of and the impact that it's going to have on the dollar, because a lot of the holders of our debt are foreign. And so when they look at our debt, they don't look at it from the prism of a dollar. They look at it from their own currency. And so if you're European and you've got money in US treasuries and you're getting 4 or 5%, but you're a euro-based investor, and you think, well, the dollar could drop another 10 or 20% this year in terms of euros, why would you want to just hold those treasuries? You're just going to lose a lot of euros holding treasuries. And so I think you're going to see more selling in the bond market as the dollar goes down. In fact, what you're seeing now is foreigners are selling all their U.S. assets. They're selling their U.S. stocks, their U.S. bonds, their U.S. dollars. U.S. stock market's been overvalued for a long, long time now. And now, finally, people are starting to notice how expensive our stocks are. And now that the dollar is falling, it makes it even riskier for foreigners to own those stocks, but particularly the bond. Because at least with a stock, you can say, well, the stock could grow and their earnings can grow. And so even if the dollar is going to drop 5 or 10%, I can still make more if the stock grows by 20 or 30%. But when you're buying a bond where the most you can get is the coupon, and the coupon's 4 or 5%, there's no way to offset the foreign exchange loss. So when the bonds really start to get hit and interest rates rise, and if we start to see especially a big upturn in unemployment, right? So now the economy is weakening and interest rates are rising. Even if inflation is rising, the Fed is going to go back to QE because it's going to be the only way that it can try to lower those rates, because rate cuts won't work. They're going to have to go into the market and buy the bonds that nobody wants. But the problem is, in order for the Fed to buy the bonds that nobody wants, it has to create the dollars that nobody wants to pay for them.
And let's not pretend this is some kind of mysterious phenomenon. The writing has been on the wall for years, decades even, but people just didn't want to read it. The United States is living on borrowed time and borrowed money. We've exported our inflation, imported cheap goods, and kept the illusion of prosperity going with low interest rates, credit cards, and foreign appetite for our debt. But here's the punchline. The rest of the world is finally waking up. They're realizing that lending to the United States is like loaning money to your unemployed cousin who swears this next business idea is going to make him a millionaire. Just one more loan, bro. This time it's different. But it's not different. It never is. The rest of the world is moving away from the dollar because they don't want to be caught holding the bag. You think the Chinese are buying all that gold because it glitters? No, they're buying it because it's the only monetary asset with no counterparty risk. It doesn't require trust in a central bank. It doesn't care who wins the next election. It doesn't evaporate during financial crises. Gold just is. Meanwhile, what are we doing in the US? Selling our gold, selling our silver, selling our energy security, our manufacturing base, our common sense. We're raising debt ceilings like a circus act, every administration becoming a master at kicking cans down the road. At some point, the road ends. And when it does, it's not going to be pretty. There's a big difference between an orderly revaluation and an uncontrolled collapse. Guess which one we're headed toward? You know, there's this idea floating around that if we just revalue gold, maybe peg it at $20,000 an ounce, we can somehow fix all of our problems. As if a spreadsheet entry at the Treasury is going to undo 50 years of financial mismanagement. That's not how it works. Revaluing gold might sound fancy, might even give a few senators something to tweet about, but unless you back the dollar with gold, and I mean really back it, none of this means a thing. You don't solve systemic insolvency with accounting tricks. You fix it with discipline. And let's be honest, our government wouldn't know fiscal discipline if it smacked them upside the head with a stack of T-bills. The only scenario where a gold revaluation makes sense is if you're returning to a gold standard. But guess what? That would require cutting spending, balancing budgets, living within our means. In other words, doing the exact opposite of everything we've done for the past half century. The reason we went off the gold standard in the first place is because it was working too well. It held politicians accountable, it limited government excess, and that's precisely why they had to get rid of it. There's this revisionist fantasy that gold failed. That's total nonsense. Gold didn't fail. Politicians did. Bureaucrats failed. Central bankers failed. Gold did exactly what it was supposed to do: preserve value, provide monetary discipline, keep governments from running wild with inflationary policies. And now, after all these years, we're finally feeling the consequences of abandoning it. Look around. The dollar's purchasing power is eroding, the middle class is vanishing, real wages are stagnant, and asset bubbles are so inflated they make Weimar Germany look conservative. Housing prices? Sky high. Stock market? Priced for perfection. Crypto? A playground for speculators and meme lords, as if Dogecoin is going to bail out a $34 trillion national debt. And speaking of crypto, let me touch on something here. Every time I point out the flaws in Bitcoin, someone says, "Well, Peter, if Bitcoin's not the future, then why are so many Americans buying it?" That's exactly why I'm concerned. Americans are buying it. The same Americans who bought Beanie Babies and GameStop at $400 a share. The rest of the world is dumping it while we're loading up like it's a retirement plan. It's like the last people clinging to the Titanic's piano, thinking it's a lifeboat. You ever wonder why central banks aren't buying Bitcoin? You think they don't have access to the same YouTube influencers and laser-eyed libertarians? Of course they do, but they're not interested in magic internet money. They're buying gold, not because it's trendy, but because it's timeless. It's the ultimate reserve asset. It doesn't crash when Elon tweets, it doesn't vanish when an exchange gets hacked, and most importantly, it doesn't need hype to hold value. Central banks are full of PhDs, economists, and yes, plenty of incompetence. But they do understand one thing: risk. And they see risk in holding a digital token created 15 years ago by someone nobody can identify. They don't want to explain to their people why they back their currency with an asset that can drop 50% overnight because a TikTok influencer changed their mind. Gold, on the other hand, has history. It has trust. It has weight. It can't be inflated. It doesn't need validators. You don't need electricity or a hardware wallet or a stable internet connection to use it. You don't need to pray your blockchain doesn't fork. You hold it. You own it. That's it. And the irony is, all the things Bitcoiners say about fiat currency, they're right. Fiat money is broken. The system is rotten. The dollar is losing credibility. But their solution, Bitcoin, isn't money. It's a speculative tech stock with a good marketing campaign. If you want an actual monetary asset that stands the test of time, you don't need to reinvent the wheel. It's been here all along. It's called gold. You want to store a value? Ask yourself what the most successful, powerful institutions in the world are buying. It ain't Ethereum. It's not Cardano. It's not Solana. It's gold. Russia's buying it. China's buying it. India's buying it. The BIS is buying it. They're not doing it for fun. They're doing it because they see what's coming. The era of dollar dominance is over. The BRICS nations know it. The G7 knows it. Hell, even Washington knows it. They're just not admitting it yet. They're hoping nobody notices. But when you have over 100 countries looking to trade outside the dollar system, setting up alternative settlement systems, using local currencies, or even settling in gold, and that's a revolution. Quiet maybe, but a revolution all the same. And this isn't something that's coming in 10 years. It's happening right now. Saudi Arabia no longer demands dollars for oil. That's the end of the petrodollar. That's the end of the deal we made in the 1970s that kept our deficits financed and our empire running. And once the dollar is no longer needed to buy energy, you'll see the final unraveling. Treasury demand will dry up, rates will spike, inflation will explode, and then we'll be stuck. We can't print our way out this time, because the more money the Fed prints, the faster the world will dump our bonds. The more we monetize the debt, the more we destroy the dollar. It's a trap. And the only escape hatch is going back to a monetary system that people actually trust. That means hard money. That means fiscal responsibility. That means real rates of return, not manipulated ones. And most importantly, it means gold. So what should you do? Well, if you're holding nothing but paper, dollars, bonds, tech stocks, you're the bag holder. You're the last one at the poker table and everyone else just left with their chips. If you don't own real assets, gold, silver, hard commodities, you're not diversified, you're exposed, you're vulnerable. And when the next crisis hits, and it's not a matter of if but when, you'll find that your dollars won't go very far. But an ounce of gold, it still buys what it always has. So ignore the noise. Forget the hype. Don't listen to the crowd that says gold is obsolete. It's not. It never was. It's just been sleeping. And when it wakes up, which it already is, the revaluation won't be polite or orderly or fair. It'll be brutal, and it'll catch most people off guard. Don't be one of them.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.